Welcome to our channel. My name is O'Brien and I would like to thank you for watching this video. If you find value in it, please like and subscribe. And if you have any questions, please put it in the comment area below. Thanks again for watching. This video is on how to trade part-time with a full-time job. We're going to go over 4 different trading strategies. But before we do that, we want to kind of set a framework on what type of person these 4 different trades will work for or work best for. All right, so obviously the person has to have a full-time job, right? Someone who's working Monday through Friday. We don't have to have it, but that's the framework of who we're kind of demonstrating these type of trading strategies for. Number 2, the person is looking for low maintenance. They're not looking to do any type of trading every day. They're looking to trade maybe once or twice or maybe up to 4 times a month at the most. And we are assuming that this person has an account about $15,000 and that they have a margin account. Okay? Not an IRA, but these strategies can work in an IRA, but we are assuming the person has a margin account and that they are looking to increase their income or supplement their income each month by making 2 to 5%. The Dorian Way is about making 2 to 5% a month. And so that's 24 to 60% annualized. And what we're trying to show is that someone with a full-time job can do a certain or 4 different type of strategies or strategies like the ones we're going to demonstrate and still be successful and not have to manage the account a lot. Okay. So the first type of strategy we're going to discuss is the naked put. The naked put is a strategy that a lot of people are aware of because it's a way that you can own stock at a discount. So the naked put that we're going to be discussing is going to be done on a company that is really solid, that you don't have to worry about it going out of business, or a company that pays a dividend or an ETF type of index, so that you do not have to worry about earnings or a CEO, or you don't have company risk basically. So, but the first example we're going to jump into is Apple. And we have pulled up Apple here and we're looking at the option chain and we're going to pick 30 days or something around 30 days because the premise is that we want to make monthly income 2 to 5% on average or consistently per month. And so we're going to pick that time frame. We're not going to pick long dated options. We're not going to pick short dated options. We're going to pick some of the middle ground, but around the 30 days to expiration. So in this case, we're going to jump into this 33 days to go with Apple on this example. And then what we want to do is sell naked puts to own shares with the premise that we're okay with owning the shares and the companies that we do it in or the ETFs that we do it in. So, and we want to have a decent chance of being assigned and a decent chance of not being assigned. So we think at the 30 delta or around the 30 delta is the best delta to sell at. So we're going to look at this 127 strike on Apple. And so we're going to sell that 31 delta here because it's around the 30 delta. We're going to sell the 31 delta by clicking on the bid, and then we're going to put the price down here as the mid price, and the mid price is 208. So if we sold this, we will receive $208. So we put a little bit more framework around this. Once again, we have a $15,000 account with the buying power ability to up to $30,000 because the brokerage firm will let you borrow 100% of what you put in. So if you put in $15,000, they'll let you borrow another $15,000 to trade stock. So we're going to use that as our premise that we have up to $30,000. So we're using a margin account. We sold the put in Apple at the 27 strike. We're receiving $208 into our account, and they're going to put almost a little over $2,100 into escrow to the side. This is how much the buying power is required to do the trade. And the max loss if Apple goes to 0 is just under $12,500. We do not have to worry about Apple going to 0. We're going to do these type of trades on companies that have a very small probability of going out of business or indexes that are not going to go out of business. So On the $15,000 we have received $208 on that. So that's about 1.4% on the 15,000 to this point. And this is the first trade that we're going to do, is the naked put. So we have some more capital. So we're going to go in to do a naked put on an index, an ETF, to give you an example. So we're going to go once again around that 30 days. This is 33 days as well. And we're going to sell around the 30 delta again. So this one's going to be the 31 delta as well. And we're going to make sure that it's at the bottom here. And this one's a little cheaper than Apple. Apple's trading at a little over $130. So this one's a little cheaper. So we're going to do 2 contracts in this ETF. This is the EEM. It's an emerging market index. It's the most popular emerging market index. It's a index that pays a semi-annual dividend, or every 6 months. And so we're going to do 2 contracts here on this TastyWorks platform that we're demonstrating. So this is going to require a little over $1,800 of buying power that we have to put to the side. So with Apple, it was around $2,500, I believe, and this is another $1,800. So we still are under our $15,000 of using buying power. This right here is your max loss. If the ETF went to 0, is a little over $10,000, right? So we know once again that this ETF is not going to go to 0. So we're collecting another $140. As you can see here, your max profit as an option seller. So I'm assuming once again that you are someone who's looking to trade or supplement your income through trading options, and you have some framework about options. If you do not, please look at some of our other videos about the basics of options, because these are powerful strategies that someone who is working a full-time job Monday through Friday can utilize to make a lot of different money, or consistent money, to supplement their income month after month after month, right? The Dorian Way is about making 2 to 5% on each month consistently, as we indicated. So one of the best ways to do that is to sell naked puts with the thought process is that you're okay with taking ownership of the shares. And if you're okay with taking ownership of the shares, then we'll move on to our second type of strategy. So the second strategy is that if you had to take ownership of the shares, so let's jump back to this Apple trade first. And let's say that you had to take ownership of Apple, and because your cost basis on Apple was your 208, so your cost basis on Apple was about the 25, just under the 125 strike, right? So let's just say your cost basis was 25, and you had to take ownership of the shares because it expired below the 127 when you initially sold that put. Then your cost basis is 125. So now you can do what we call being the landlord, or renting out your shares to own. You're renting your shares to someone to own it, giving them a contract. Okay, so in this case, we are going to sell a call against the shares we have, because we're saying after the original time frame, after the original put that we sold, we had to take ownership of the shares. And now we own the shares, and we want to collect some monies on those shares. We have a cost basis of 125, so you can sell the second strategy here. You can sell a aggressive covered call. Okay, so if your cost basis is 125, you can sell the 125 and collect, let's just say, another $8. So originally you received about $2 on Apple. Now you're receiving $8, so that's $10 altogether, or $1,000 that you received. So your cost basis now, if you were your original cost basis, your original strike that you sold it at was 127. Now your cost basis is basically 117, because you received $10. You received $1,000, because every option or every point equals $100. So you received $10. So 10 times 100 is $1,000. All right, so you can sell an aggressive call, and then if it goes up, then you will still collect the $1,000 when it's all said and done, and that's pretty awesome. If it goes down, then it's covering you all the way to 117, and a company like Apple hasn't seen those levels in some time. That would be actually a very high probability trade for you, right? So the deltas right now, our bet is saying it is only a 11% chance that Apple is going to be below 119 in the next 30 days. All right, so obviously we sold the naked put, 30 days passed, we had to take ownership. So now we're showing that if this was the next 30 days, these numbers are not going to be exact, but we have to kind of set a framework on what could happen. So this is really realistically that if you had to take ownership of Apple with a cost basis of 125, that price might be around $8 a share to sell, right? So that's the aggressive way to sell a covered call. You can also do that on the EEM, the Emerging Market Index. And let's go back over to that really quickly. And you can see that this is the 33. We sold a naked put at the 70 strike for 70 cents, and we sold 2 of them, right? So with a call basis just under 52. So we're going to act like we received the shares once again with a call basis around 52. And so we would sell another aggressive call on it by clicking on the bid on the call side. We have the shares. So we would collect, as I say, in this case, another 50 cents or 256 with 2 contracts there. And so we collected more monies. So originally we collected about 70 cents. Now we're collecting about, let's just say 256. So if we just round this up, we're collecting about 320 in premium, and that will, so if we originally sold at the 52, our cost basis is going to be a little less than $50. That's pretty good, right? This index would have to fall quite a bit. So you're selling the naked put, and then if you have to take ownership of it, you're selling an aggressive call. You can sell an aggressive call, or you can sell a call that's a little out of the money to give you a little bit upside. But in this case, you're trying to just repeat the process of selling a naked put, and then if you have to take ownership, selling an aggressive call for your shares to be taken away. You want your share to be taken away because you're just trying to collect the premium. You're just trying to be able to get some monthly income consistently. All right, so the third type of strategy that we're going to discuss is the collar. And the collar strategy is that if you had to take ownership of the shares, right? So first we sold the naked put, and we're assuming that you had to take ownership of the shares, right? Most of the time you won't, because you're selling it at a 30 delta. And so it's only a 30% chance that you will have to take ownership of the shares, or a 70% chance that you will not. But I just say for demonstration purposes at this point that you had to take ownership of the shares after you sell the naked put. Then you sold a aggressive call, and then your shares were not taken away, right? Or if you decide not to sell an aggressive call, what you can do is our third type of strategies. You can sell a collar strategy, because let's just say your stock fell and you're nervous about it going down more. Right? So you can protect your downside by selling what is called a collar strategy. All right, so let's jump into the collar strategy here. All right, so we're going to hit clear here. And the premise is that you own 100 shares of Apple, because we sold that 127 strike. We're saying that Apple went down. We had to take ownership of the shares, and that we're a little afraid that Apple has, came out with maybe some bad earnings or something, and we want to protect it from falling more, or earnings are about to come and we want to protect our downside a little bit more. So we own the shares, even though we know Apple is not going to zero, and long term, most likely it's going to go up, but we're afraid of the short term within this 30-day period that we have these options. So we decide that we're going to do a collar on our 100 shares. So you own 100 shares of Apple. That's the premise once again. And then we are going to sell a covered call. And I just say we sold an aggressive covered call. We said that it was around, the call spaces are around, it was around 125. So we sell that covered call at 125, and then we can take some of those monies, and let's say it's around $8. We can take some of those monies and buy a put, right, to protect ourselves. Our cost basis is 125. So we're going to buy a put, let's just say at this 122. So we stop losing at 122, but we're collecting, let's just say that 122 is about $100. We collected $800 on the call. So we're still collecting $700, but we have limited our downside. We minimized our downside by buying this collar strategy, okay? So the key to this though is doing an aggressive covered call. You're trying to collect money still. And then when you're doing this third strategy with the collar, you're just trying to protect yourself. Okay, you're just trying to protect yourself from that stock or that index falling more. All right, so let's go over to this curve view and let's look at this really quickly. So you can see here that it's still, this is the at the money area. This is your 100 shares in Apple. If it goes up, you're still going to win 100% of the time. If it goes down, you can still win, and you stop losing once it hits this, your short or your long put here at the 122. This is an example. This is a real life type of example that you can do to protect yourself. This is for people who are, once again, working a full-time job Monday through Friday and do not want to do a lot of maintenance, only have about a $15,000 account. You can sell this, you can trade Apple, you can trade the EEM that we talked about. Now we're going to go over to our fourth strategy here. All right, so our fourth strategy is selling what we call a bullish bear strategy. We're going to show this two different ways. We're going to show it in the SPX. The SPX is the S&P 500 index. Once again, we're trying to do these things in most of the time in indexes or in stocks that we really love, that we're okay with owning. Okay, because we know that they're not going to go to zero. You can't do it in a stock that you love though, that is a very volatile stock, because then you're going to have to worry about it. You want to do it in a stock that's solid, that after the 30 days, if you didn't look at it and you had ownership of those shares, you're perfectly fine with that, because that stock is going to be solid over time. It's going to pay you a dividend. It's not going to zero. Or you can do these things on indexes. So we talked about the naked put, we talked about the aggressive covered call, we talked about the collar. Now we're talking about what we call in the Dorian Way bullish bear strategy. That's when you are buying a put spread and you're selling a put spread, but you're doing it for a credit. So it has a bearish part to it and a bullish part to it, but it's more of a bullish strategy, because all these strategies are bullish strategies. It's for someone who is, once again, working full time, doesn't have a lot of time, doesn't want to do a lot of maintenance on their trades, and the market has a tendency to drift up over time. So we're trying to give them the probabilities, not only the delta probabilities of starting off around the 30 delta, but also the probabilities of the market just drifting up over time, because most of the time it's going up 52, 53% of the time. So, and if it drops, what's protecting you is that you're okay to take ownership of the shares, and then you can wait it out by selling aggressive calls or the collar strategy that we mentioned. But this strategy is for someone who is trying to kind of put a little bit more gasoline on their performance, okay? And someone who maybe has a little bit more time to look at their portfolio a little bit more than once a week, maybe 2-3 times a week, to look at their portfolio on the desktop or on an app, okay? But we're going to show two different examples. First, we're going to talk about the SPX. The SPX is, once again, is the S&P 500 index. It's the cash settled index. It's an index. It's no dividends associated with it. It's no, you can't be assigned shares, and if you assign, it's just cash. It's just cash that's exchanged. All right, so we're going to go over this one. We're going to go over the bullish bear strategy in this, and then we're going to talk about it on options on futures. And that's going to really be exciting. All right, so we're going to the 33 days again here. We're going to buy the 40.70 on this, and we're going to sell the 40.65, and then we're going to sell the 39.25, and we're going to buy the 39.05, and then we're going to do 2 contracts here on this SPX on the bullish part of this trade. So this is going to give us $300, okay, with the potential of making $800, and we'll explain that here in a second. Our max loss is going to be $3,200, and the buying power effect that they're going to require us to put to the side in escrow, just like the other trades that required us to put some money to the side, is $3,200, right? So we collected 208 basically on Apple, we collected 140 on the EEM, and now we're collecting 300 on this SPX, okay? And this is a bullish bear strategy. and it's a bullish strategy overall, but you're receiving a credit with the potential to make more than what the credit is. It's one of those few times, or one of those rare times, that as an option seller, you can make more than what you're receiving up front for selling the options. All right, so this right here, we're going to go to the curve view and we're going to break this down. So this is the at the money line. If the index goes up, the S&P 500 goes up, you're going to win 100% of the time. If it goes down, you can still win. And if it goes down and it lands in between your two short strikes, then you're actually going to make more. You can make as much as $800 on this trade, and you don't start losing. Your break even is way down here around just above 3,900. So it has to fall quite a bit before you start losing over here in this red zone. So this is what is called a bullish bear strategy. It's for someone who is who's working a full-time job, once again, but has a little bit more time to do a put spread or a bullish bear strategy. This is buying a put spread and selling a put spread simultaneously to be able to collect premium, but have some short delta, it's a hedge attached to the trade, because this part right here is actually hedging you. And this part is actually hedging you on the trade. So it gives you time for this to work. The S&P, the index, would have to fall significantly before you have a problem. Okay. And if you have a problem, what you're going to do is just get out of the trade. If your short strike is hit, this strike here, if it's hit, you're just going to get out of the trade until you learn how to adjust your trades. And you can learn that with the Dorian Way. We talk about that in course 1 and lesson 7 of course 1. We teach you how to adjust your trades in an effective way so you can continue to win even when you're wrong. But in this case, the only thing you have to think about, if I'm touched, if I'm breached, if my short strike is breached, then I'm going to exit the trade. But that's going to happen very, very rarely is that going to happen. Okay. All right. So now let's look at this same type of trade by doing it with the options on futures. So the Dorian Way, we teach people how to trade options on futures as well as options on stock. So we believe options on futures are excellent for people who work a full-time job Monday through Friday and don't have time to look at their account until at night, because futures trade 24/5. They trade 5 days a week. They start at 5 p.m. Central Standard Time on Sundays, and they close at 4 p.m. Central Standard Time on Fridays. So they do have some off time in between that for like 15 minutes, 30 minutes at times, but it's basically 24/5. All right, so let's continue and let's talk about this ES. It's the same type of index as the S&P 500, as that SPX that we just went over. Okay, but the difference is option on futures. They trade at night once again, and the buying power situation is different. But you still don't have to worry about being assigned until expiration. And this is the same type of strategy that we just did, and we're going to go into the same time frame. So we got 33 days to go, and we're going to try to set this up almost identical. So we went to the 4070 that we purchased, and we bought the 4070, sold the 4065. And so we sold this 3925 and we bought the 3905. Sell that and we buy this. All right, so, and what we're going to do is we're going to try to make it equivalent to the SPX. So we did 2 contracts, and the max loss on that SPX was about, I think it was around $3,000. So what we're going to do is we're going to sell 4 of these. Okay? And then we're going to go up to the put side, or the bear part of the trade that we're looking at, and we're going to sell 2 of these. Okay? Or buy 2 of these. So we have 4 that we sold put spreads and 2 that we bought. All right, so then the setup, the trade is pretty much the same. You can see that on the max profit on the SPX was 800. This is basically the same, 780, and the max loss was around the same thing. But the difference is the buying power effect. Okay, the buying power effect is only about a little over 1,600 the ES, options on futures. So once again, we teach people how to trade options on futures. It's regulated by a different regulator than the SEC. It's regulated by the Commodity Futures Trading Commission, and the margining system is different. On stock options, it's primarily regular T margin, so you have to put up your max loss when you're doing a spread, similar to what we're doing here. When you're trading options on futures, it's span margin, and it's similar to like portfolio margin, but portfolio margin requires you to have a certain size account, at least over 125,000. But with span margin, you can trade it regardless of what size account you have, and it's going to give you what is truly the risk, what's the real risk. And right now, this real risk is just over 1,600. It could bloom up to your max loss, just like the SPX is requiring you to put up initially, but your real risk is about that 1,600 when you first start, okay? And we like this ES because it's really solid. You can trade this at night. You can look at it, make your adjustments, or you can take it off your profits and all those kind of things. Let's break down what kind of percentages you can think about or you can consider. All right, so initially our premise was that you are selling a naked put, and then you had to take ownership of it, and then you sold an aggressive covered call, and then or you did a collar strategy, and that's selling the call, taking some of those monies and buying a put to protect yourself. And then we went over selling the bullish bear strategy. So let's break it down. If you were doing on a $15,000 account, if you were selling the naked put on Apple and you received about $208, that would be about 1.4% on the 15,000. Okay? And if you were selling 2 naked puts on the EEM and receiving that $140, that would be about 1% on your 15,000. And then if you sold the ES, let's say the ES and not the SPX, it's still basically the same, but the ES is a little better for someone who's working a full-time job because you can actually trade it at night, okay? And it's obviously trading during regular trading hours as well. All right, so if you sold that one, you received about $280, and you received about 1.9% on the 15,000. Okay, you received about 1.9% on the 15,000. And then if we put it all together, you received about $628 for that 30-day period. And that's about a return of 4.2% of your $15,000. So that's awesome. We talk about in the Dorian Way making 2 to 5% on average consistently month over month to be able to supplement your income. So if you did this type of strategy where we set it up, and this is a real type of strategy, this is a real world type of strategy that you can do on the examples we showed on companies that's similar to that or indexes that are similar to that. Okay, so you receive $628. You're getting 4.2% basically on your 15,000. That is 50%, a little over 50% annualized if you can average that over 12 months. We would like to thank you for watching this video. If you found value in it, please like and subscribe. And if you have any questions, please put it in the comment area below. Once again, we'd like to thank you for watching this video.